The Treasury Bond Market just broke. Your savings will evaporate next. The year is 2025 and something impossible just happened in the bond market. Treasury yields spiked to levels that were supposed to be mathematically impossible while the dollar was still standing. The world's safest investment just became the world's most dangerous trap. And if you're holding bonds in your retirement account, which statistically you are, you're about to watch decades of savings disappear in months, not years. Months. The Treasury bond market isn't just struggling, it's breaking. And when the $27 trillion Treasury market breaks, everything else breaks with it. Your 401k, your pension, your purchasing power, gone. But nobody's telling you. Financial advisors are still recommending balanced portfolios with 40% bonds. The Fed is pretending everything's under control. The media is covering celebrity gossip while the foundation of global finance collapses in real time. Because if they told you the truth, if they admitted what's actually happening, the panic would accelerate the death spiral. Better to keep you calm, keep you invested, and let you discover you've been holding worthless paper only after it's too late to escape. Let me show you what's happening right now, what it means for your money, and why the next 6 months will separate people who prepare from people who lose everything. This isn't theory. This isn't doom posting. This is math. And the math just stopped working. For 80 years, US Treasury bonds were considered the safest asset on earth, safer than gold, safer than property, safer than anything. When investors got scared, they bought treasuries. When countries needed reserves, they bought treasuries. When pension funds needed guaranteed returns, they bought treasuries. The entire global financial system was built on one assumption. US government bonds always pay, they never default, and they hold value. That assumption just died. And most people haven't noticed yet. Look at what happened in October 2024. The 10-year Treasury yield, the benchmark rate for all borrowing in America, spiked above 4.8%. That doesn't sound dramatic until you understand what it means. Bond prices and yields move inversely. When yields go up, bond values go down, and they went down hard. If you bought a 10-year Treasury bond in 2020 at 0.5% yield, that bond lost over 40% of its value by late 2024. 40%. The safe investment just wiped out nearly half your money. But that's just the beginning. Because yields rising means the US government has to pay more to borrow money, and we borrow a lot, $36 trillion in debt and climbing. In 2020, the average interest rate on that debt was under 2%. Manageable barely. In 2025, it's approaching 4%. That means interest payments alone now exceed $1.2 trillion per year, more than we spend on defense, more than Medicare, more than everything except Social Security. We're paying $1 trillion annually just to service debt, not to pay it down, just to cover interest, and it's accelerating. Here's where it becomes a death spiral. To pay that interest, the government issues more bonds. But who's buying? Foreign central banks were the largest buyers for decades. China, Japan, Saudi Arabia, all of them funding America's deficit spending by buying treasuries. That's over. China has reduced its treasury holdings by over $400 billion since 2021. Japan, drowning in its own debt crisis, stopped being a net buyer. OPEC nations are diversifying into euros, yuan, and gold. The biggest customers just left. So who fills the gap? The Federal Reserve. They print money and buy bonds themselves. That worked during COVID. They bought trillions in treasuries, keeping yields artificially low and propping up bond prices. But in 2022, inflation exploded. They had to stop. They had to reverse course, raise rates, and start selling bonds from their balance sheet. Quantitative tightening, they called it. Translation: the biggest buyer became a seller. Supply up, demand down. Prices collapse. Yields spike. And here we are. Now let me explain why this isn't just another market cycle, why this is structural collapse. The Treasury market has always had a bailout mechanism. When things got bad, someone stepped in. In 2008, the Fed bought bonds. During COVID, they bought even more. Foreign governments absorbed supply. Pension funds bought duration. There was always a buyer of last resort. That safety net just disappeared. And without it, basic market mechanics take over. When there are more sellers than buyers, prices fall until they find equilibrium. But Treasury bonds can't fall to equilibrium. You know why? Because falling bond prices mean rising yields, and rising yields make the debt unsustainable, which makes investors demand even higher yields for the risk, which makes prices fall further. It's a feedback loop. And we just entered it. Look at the warning signs that everyone's ignoring. In March 2023, Silicon Valley Bank collapsed. Why? Because they held long-term Treasury bonds. When yields spiked, those bonds lost value. When depositors panicked and withdrew money, SVB had to sell bonds at massive losses. They went from solvent to bankrupt in 48 hours. The safest assets in the world destroyed them. 3 more regional banks followed. The contagion spread. The Fed had to step in with emergency lending to stop the bleeding. But here's what nobody asks. If Treasury bonds are risk-free, why did they kill 4 banks? The answer is simple. They're not risk-free anymore. They're the risk. Pension funds are next. State pensions, corporate pensions, union pensions, they're all massively allocated to Treasury bonds. It's literally in their mandates. They have to hold safe assets, and bonds were always considered safe. But when your safe assets lose 30 to 40% of their value, your pension fund goes from fully funded to deeply underwater. CalPERS, the largest public pension in America, has over $150 billion in fixed income. Much of that is treasuries. When bond values collapse, they can't meet obligations. Retirees don't get paid, or benefits get cut, or taxpayers get forced to bail them out. There's no good option. Every choice is catastrophic, and it's not just public pensions. Your 401k, your IRA, if you have any allocation to bond funds, and most target date retirement funds do, you're losing money right now, and you probably don't even realize it yet. Because the statements come quarterly. By the time you see the damage, it's already done. The corporate debt market is imploding too, because corporate bonds are priced as a spread over treasuries. If the 10-year treasury yields 5%, a risky corporate bond might yield 7%. When treasury yields spike, corporate borrowing costs explode. Companies that need to refinance debt suddenly face rates double what they were paying. Some can't afford it. They default. Their bonds collapse. The high-yield market, junk bonds, freezes up entirely. Nobody wants to lend. Credit markets seize, and when credit freezes, the real economy stops. Companies can't borrow to make payroll. They lay off workers. Unemployment spikes. Consumers stop spending. Recession begins. Except this isn't a normal recession, because normally the Fed cuts rates to stimulate the economy. They make borrowing cheap again. Problem is, they can't. If they cut rates now, inflation reignites. The bond market already doesn't trust them. If they pivot back to money printing, Treasury yields spike even higher because investors demand more return to compensate for inflation risk. The Fed is trapped. Raise rates, you crash the economy. Lower rates, you crash the currency. There's no path out. It's checkmate. And the only question is which piece falls first. Let me give you the international perspective because this is where it gets truly terrifying. Treasury bonds aren't just investments. They're the collateral for the entire global financial system. When banks lend to each other, they post treasuries as collateral. When countries settle trade imbalances, they use treasuries. When derivatives get margined, treasuries back them. The whole system assumes treasuries are stable, liquid, and valuable. When that assumption breaks, the collateral backing trillions in transactions becomes questionable. Margin calls go out. Liquidity evaporates. Counterparty risk explodes. It's 2008 all over again, except the assets that failed last time were subprime mortgages. This time it's government bonds. Last time we could bail out the system by having the government buy bad assets. This time the government's assets are the problem. Who bails out the treasury market? Nobody. There's no lender of last resort for the lender of last resort. Now let's talk about what happens to you personally. Because this isn't abstract finance theory. This is your rent, your groceries, your ability to survive next year. When treasury bonds collapse, interest rates across the entire economy spike. Mortgages, car loans, credit cards, student loans, everything. The average 30-year mortgage rate in 2021 was under 3%. In late 2023, it hit 8%. People stopped buying houses. The real estate market froze. Home prices should have crashed, But they didn't because nobody could afford to sell either. They were locked into cheap mortgages. So inventory disappeared. You got the worst of both worlds, high prices and high rates, affordability destroyed, an entire generation priced out of homeownership permanently. Credit card rates are already approaching 25%. At that rate, carrying a balance becomes impossible for average Americans. Defaults spike, banks tighten lending, credit availability vanishes, and when people can't borrow, they can't spend. The consumer economy, which is 70% of US GDP, contracts. Hard. But the real killer is what happens to the dollar itself. Because when foreign central banks dump treasuries, they're also selling dollars. They're getting out of dollar-denominated assets entirely. And when they sell dollars, the currency weakens. A weaker dollar means imports cost more. And America imports almost everything. Your iPhone made in China, your clothes made in Bangladesh, your electronics made in Taiwan, your car parts made in Mexico, your coffee grown in Colombia, your bananas shipped from Ecuador. When the dollar loses value, all of that gets more expensive. Inflation returns with a vengeance. Except this time it's not supply chain issues, it's currency devaluation, and that's permanent. The Fed can't fix it without destroying what's left of the bond market. You're trapped in rising prices with falling asset values, stagflation on steroids. Your salary buys less, your savings are worth less. Your retirement accounts hold assets that are cratering. You're getting poorer from all directions simultaneously. And there's no policy response that helps. The government is out of options. Here's the historical parallel that should terrify you. In the 1970s, Treasury yields spiked to 15%. Inflation hit double digits. It took a decade of economic pain to fix. Paul Volcker raised rates so high he triggered the worst recession since the Depression. Unemployment hit 10%, but it worked. Inflation came down. Bond markets stabilized. Except we can't do that now. You know why? Because in 1980, US national debt was $900 billion, painful but manageable. In 2025, it's $36 trillion. If yields hit 15% today, annual interest payments would be $5.4 trillion, more than the entire federal budget. It's mathematically impossible. We can't Volcker our way out of this. The debt is too large. The only options are default, which destroys the dollar's reserve status and crashes global markets, or inflate the debt away, which destroys purchasing power and crashes living standards. Either way, you lose. The middle class gets wiped out. Savings evaporate. The wealth gap becomes unbridgeable. Let me show you what smart money is doing. Because they're not holding bonds. Ray Dalio has been warning about the death of the 60-40 portfolio for years. That's 60% stocks, 40% bonds, the classic retirement allocation. He says bonds will lose money for the next decade. He's shifted to gold, commodities, and inflation-protected assets. Warren Buffett's Berkshire Hathaway is sitting on over $150 billion in cash. Not bonds. Cash. Why? Because he's waiting for the collapse. When asset prices crater, he'll buy. But he's not holding bonds while they fall. Stanley Druckenmiller, one of the greatest macro traders alive, has been short bonds for years. He's made billions betting against treasuries. These aren't pessimists. They're realists reading the same data you can access. The difference is, they're acting on it. Bill Ackman publicly stated he's shorting long-term treasuries because the math doesn't work. He calculated that with current deficits and demographics, there's no way yields don't spike further. He's not hoping for collapse. He's positioning for inevitability. Meanwhile, your financial advisor, who makes money whether you win or lose, keeps telling you to stay the course. Stay diversified. Bonds are safe. It's all fine. They're either incompetent or complicit. Either way, it's your money that evaporates. So what do you actually do? First, understand the reality. Traditional safe havens aren't safe. Treasury bonds will lose value. Bond funds will decline. Money market funds holding government debt will break the buck. The assets you thought protected you are the ones that will hurt you. Accept that. Second, if you're holding long-term bonds or bond funds, understand your risk. A 20-year Treasury bond loses roughly 15% of its value for every 1% increase in yields. If yields go from 4% to 6%, you lose 30%. If you're young, you might recover. If you're near retirement, you're finished. Consider your timeline and act accordingly. Third, inflation-protected securities like TIPS might preserve some value, but they're not perfect. The government calculates inflation using CPI, which understates real price increases. You'll get some protection, but not full protection. Fourth, diversification matters more than ever, but not the diversification your advisor means. They mean stocks and bonds. That's not diverse. That's two sides of the same system. Real diversification means hard assets that hold value regardless of what paper does. Real estate, but only if you can afford it without leverage. Commodities, precious metals, productive land, physical things with intrinsic value. Fifth, consider international diversification, but carefully. Other countries have their own problems. Europe's bond markets are even worse than America's. Japan's debt-to-GDP ratio is over 250%. China's economy is a black box of hidden debt. But some countries, Norway, Switzerland, Singapore, have better fundamentals. If you can hold assets in stronger currencies, you hedge against dollar collapse. Sixth, increase your income-generating ability. In currency crises, the people who survive are those who can produce value regardless of what money does. Skills, knowledge, relationships, these can't be inflated away. If you're employable, adaptable, and valuable, you can navigate chaos. If you're dependent on fixed income from bonds or pensions, you're vulnerable. Seventh, reduce dependence on the system. The more you rely on government promises, corporate pensions, or financial markets for survival, the more exposed you are. Food security, energy independence, community networks, these sound extreme until the system fails. Then they're the only things that matter. Eighth, educate yourself on what's actually happening. Read the Treasury's own reports on debt sustainability. Look at CBO projections. They admit the trajectory is unsustainable. Check foreign central bank reserve data. Watch who's selling treasuries. Look at the yield curve. When short-term rates exceed long-term rates, it's a recession signal. We've been inverted for months. The data is public, the warnings are clear, most people just aren't looking. Ninth, prepare for rapid change. Currency crises don't unfold slowly, they accelerate. One day everything seems fine. The next there's a crisis meeting. Capital controls get announced. Bank withdrawals get limited. It happens fast. By the time you see it on the news, it's too late to move money. The window closes before most people realize it was open. 10th, accept that there's no risk-free option. Holding cash loses to inflation. Holding bonds loses to rising yields. Holding stocks crashes when recession hits. Holding gold doesn't pay interest. Every choice has downsides. The question is which risk you can live with. Personally, I'd rather hold assets that might stay flat than assets guaranteed to lose value. But that's not financial advice. That's logic. The Treasury bond market is breaking in real time. This isn't a prediction. It's not a maybe. The math is clear, the incentives are obvious, and the trajectory is locked in. We have $36 trillion in debt, trillion-dollar deficits, demographics that guarantee entitlement costs explode, and a political system incapable of making hard choices. We have foreign creditors exiting, domestic buyers exhausted, and a Fed trapped between inflation and deflation. We have pension funds holding bonds that are losing value, banks holding collateral that's declining, and retirees depending on fixed income that's evaporating. Every component of the system is failing simultaneously. And there's no cavalry coming. No one's going to fix this, not the Fed, not Congress, not the President. The problem is mathematical. You can't print your way out of a confidence crisis. You can't borrow your way out of too much debt. You can't inflate your way out without destroying the currency. The tools don't work anymore. The game is over. We're just waiting for everyone else to realize it. The Treasury bond market just broke. Your savings will evaporate next. Not because of bad luck or unforeseen circumstances, but because of mathematical certainty and policy choices made decades ago that are finally coming due. The bill is here, and we can't pay it. The only question is whether you see it coming in time to protect yourself. History shows that people who prepare survive. People who trust the system get destroyed. Which one are you going to be? Because ready or not, the collapse is here.